Let's take a look at Chapter 15, Problems. Chapter 15 covers quite a few topics. Most of them are around owner's equity and issues with owner's equity. I believe you'll find some of the stuff to be fairly straightforward. If some of it's going to be like, oh, I've never really seen this before, kind of a combination. But pretty much everything has that common of equity that we'll take a look at. So the first one is pretty simple. We'll start with 15.2, and that one's just issuing stock and just kind of reminding us what that looks like, just in case you don't remember. You would have definitely covered this kind of a problem back in accounting principles. But it says here, Bridget Company has $1,000,000 shares of common stock authorized with a par value of 3 and 600,000 shares outstanding. The company received $7 per share when it issued shares to the public. What is the book value of the common stock par account? And then what's the value of the additional paid-in capital? And this is very straightforward, but it's $3 per share. And obviously that's times 600,000 shares. So $3 times 600,000 is 1,800,000. So that's the value of the common stock account. And then they sold them for $7 per share. So the difference between 7 and 3 is $4. So 4 times 600,000 is 2.4 million, 2,400,000. So 1.8 million for common stock, 2.4 million for additional paid-in capital. Total equity is $7 times 600,000, which is 4.2 million. So very straightforward question. I don't think anybody will have trouble with those kind of questions. Question 3 is the stockholders' equity section of Peter Corp balance sheet. On December 31, common stock $10 par value, authorized to 100 million shares, issued and outstanding 900,000 shares, and then additional paid-in capital, retained earnings, and then total equity is $13 million. So that's kind of the situation we're in right now. And then what's different about this problem is that they are going to purchase and retire, and that's the key with this one. It's purchase and retire. If this is worded, they're going to purchase for treasury, that'd be different. So the key is when you see a problem like this one, the word retired means something, and that's going to give us a little bit different approach than if it was for treasury. So basically, they buy the stock back from whoever owns them, and they literally retire the shares. And so that changes the journal entry and how we'll go about doing this. So with this one, I think we just need to kind of go over to Excel and take a look at this one. I've got some stuff already set up. I'm just going to do this one off to the right here. So this is 15.3. And as I mentioned, the word retired means something. So let's make the journal entry to do this. And we're going to debit common stock, basically, and that would be the par value. I'm just going to say CS par, common stock par, and then additional paid-in capital. We'll debit that. We're also going to debit retained earnings, and then we credit cash for the amount of money that we spent to buy those shares. And so the problem said that we bought shares worth $1.8 million. Okay, so there's my 1.8 million. Let me format this so it looks a little bit easier to follow. So we spent $1.8 million to retire these shares. The debit to common stock par is for 100,000 shares, and those shares were $10 each. Okay, so that's $1 million. So $10 times a million or 100,000 shares. And then, so go back to the problem just to kind of, so you see the numbers here. So $10 par value right here, okay? And so that's the debit there. And then we debit additional paid-in capital. And this is where it's a little bit tricky. This one is not quite as straightforward. And what you have to do is go back to the problem, and we have to recognize that additional paid-in capital is 2.7 million, and 900,000 shares were issued. And that's, you just have to kind of recognize that combination. And once you do, you're fine. So it's 2.7 divided by 900,000. Okay, that gets you to $3. And that's the key, is you had to recognize that those shares were sold at $3 above par. So once you got that down, then this is easy, because I just take that $3 and I multiply it by the 100,000 shares, which we all know is $300,000. No question there. So now I've got 1.3 on the left, 1.8 on the right, and I just plug retained earnings. It's literally my plug number to make this number balance. So I'm reducing retained earnings by doing this entry. Okay, so this is very different than a treasury stock entry. A treasury stock entry is not anywhere like this. So this is retired, and that's the key, is because you will have problems like this in your homework for the week. Okay, question 4. It says, forever yours, manufacturer wedding rings, issued 2 financial instruments at the beginning of 17, a 10 million 40-year bond that pays interest at the rate of 11% annually, and 10,000 shares of $100 preferred stock that pays a dividend of 7.5 annually. The preferred stock has a mandatory redemption feature that requires the company to repurchase all outstanding shares at $100 per share in 40 years. So the question then is, describe how each financial instrument will affect the company's balance sheet and income statement in 2017. And the debt part of it is nothing tricky there. This is very straightforward for the debt side. So what they want us to kind of think through on the debt side is that this is just simply a bond. It's a long-term liability, so the balance sheet would include some kind of a long-term bond payable, and that would be for the $10 million. And then kind of, $10 million times 11%, that would be our $1.1 million would be interest expense every year. So we'll carry it on the balance sheet, a long-term liability of 10 million, and we'll incur 1.1 million of interest expense every year. No, I don't think that's a challenge for anybody to figure that one out. What's different for us, and we talked about this a little bit in previous chapters, is preferred stock when it has a mandatory redemption. And what that means is that the company that issued that preferred stock, when they sold that to the public, they put in the stock contract that they will buy it back in 40 years. Okay, the mandatory redemption. So whoever owns that stock in year 40 is legally required to sell it back to the issuing company. Okay, so it looks like debt. It is debt. Okay, so while it's stock, it's really debt because it really has the same characteristics as debt. So they are issuing this preferred stock. Whoever owns the stock is paid 7.5% dividend annually, and then the company has to buy the stock back, which is paying off the principal essentially when the stock hits 40 years. Okay, so it's very much like debt. So even though it's a preferred stock, because of the mandatory redemption, the company issuing this has to classify this as debt. Okay, so this is truly long-term debt. And then because we're going to classify it as debt, the annual payment is actually now interest expense. Okay, so it'd be 10,000 shares at $100 par, 7.5%, and that works out to be $75,000 worth of interest expense annually. Okay, so this is debt, and that's the key thing I want you to remember. There'll be questions about this, and normally in previous chapters and in previous classes, when you've seen preferred stock, we probably never added the mandatory redemption to it. So you treated this a lot more like just normal equity. But this is not equity once you add the mandatory redemption. That's the key words to look for. So just watch for that wording and the problems, and that'll help you out quite a bit. Okay, the next question is question 5. And this one deals with the issuing of stock. And it's not too bad. I think you probably should recognize this from accounting principles a little bit. I think you would have done a few problems like this one way back in the day. So Warren Corp has organized on January 1 of 17, authorized 500,000 shares of common stock at $5 per par value per share. During 17, the company had the following transactions. So you can see they issued shares 3 different times. They purchased some shares, and they sold some shares that were held in treasury. Okay, so very common type of transactions that a company might do. And it's very common that a company would be authorized to issue a certain number of shares but not sell them all right away. I mean, that's very common. They kind of just sell them in chunks, and that happens quite a bit, especially if it was a more if it's a more closely held company. That might be more the what you would expect to see. But even a publicly owned company would do that. They might just release one batch, see how that goes, and if the company keeps performing well, issue more and so on. So it's really not that unusual. So I've got this one set up for us in Excel. And this is it right here. So just want to walk you through. I've already got the answers in here. I just thought it might just be easier for you if I already had them here. So the first one, we issued 100,000 shares at $5. And so obviously I received cash exactly for $500,000. And it also happened to be the par value. So that was pretty easy. There's no additional paid in capital. Then we issued 50,000 shares in April, and that's at $7. So 50,000 times 7 is 350. And the $2 difference goes to additional paid in capital. Okay, and then par value is the 250. So 5 times 50 is 250, and the $2 extra goes to additional paid in capital. And then very similar type problem in June. Now we sell them for $10 per share. We got 15,000. And same thing, $5 par times 15,075. The $5 extra above goes to additional paid in capital. And then we bought some of our shares off the market in July. The stock price went down to $4. And so, and maybe that's what we realized. And it wouldn't surprise me if this company, think about that. In June, they were $10. Yeah, about a month and a half later, they went down to 4. And maybe the company thinks whatever this price drop was, we don't think it's permanent. We think it's temporary. And so let's go ahead and buy some of our shares off the market because we can maybe make some money on that. And that's kind of what they did. So they bought them for 4. They bought 25,000 for 4, spent $100,000, and that goes to Treasury. And in accounting, that would be a contra equity account. That's why it's a negative. And then we sold those shares in December at $8. So the stock price went up to 8 again. And so we made some money on that. So we received $200,000. That increases our additional paid in capital, and the treasury stock goes away. So remember that when a company sells treasury shares, it's not a capital gain or loss. Okay, that cannot go to the income statement. Because if it could, then a company could manipulate its income by doing treasury stock transactions. And that's not what we want to happen. So the chapter kind of even talks about that. Anything that runs through the income statement should really recognize transactions with outsiders. And stockholders are not outsiders. They're considered to be insiders because they're owners of the company. So anything that is treasury goes directly to equity. Okay, so additional paid in capital goes up but the company made $100,000 in cash on this, right? And that's really what you're doing. So that's one. There's a lot of reasons why companies buy treasury stock. This is one of them. Is they just think their price is undervalued and they want to make some money on it. So they're kind of making a bet on themselves that we think our stock price is too low. So if we do believe that sincerely, we'll just go ahead and buy some shares and then wait for the stock price to go up and sell them, and then we'll make some cash on that. So it's just a way to generate some cash if we're willing to, be patient with it. Okay, that was question 5. Question 6 is over here, right there. MUN Corporation's records indicate the following stockholders' equity accounts, kind of the usual suspects that we're used to seeing. Preferred stock, additional paid in capital in the preferred, and common stock. This one does not have a par value. Instead, it has a stated value, which acts the same thing as a par value with the 100,000 shares authorized. How many shares of preferred stock and how many shares of common stock have been issued? And that's the big question. So not hard to figure out, thankfully, which is good. And so all we have to do is recognize that this is 255 and the par value is 15 and do some division. So if you take 255, divide by 15, that gets you to 17,000 shares of preferred stock that have been issued. So 20,000 are authorized, 17,000 have been issued, so they could do 3,000 more shares. On the common stock side, very same thing. We know that this is $300,000. I divide that by the stated value, which is essentially the same thing as par. That gets me to 60,000. So 60,000 shares of common stock have been issued. 100,000 authorized, of course, then we can sell 40,000 more shares if we would like to. So that's just doing a little bit of division and we're good to go. Question 7 is now treasury stock. And it says Weldon Wire has issued 2,500,000 shares of $2 par common stock, average price of 10 per share. Of those, 100,000 shares were repurchased during the year for $15 each and retired. Another 200,000 of the shares were repurchased for $17 each and are held for later use. So some are retired and some are now truly treasury. We bought them and we tend to just hold on to them for something in the future. There were no other common stock transactions during the year. So basically the question is, what's the balance of the following accounts: common stock par, additional paid-in capital, and treasury stock? So let's go ahead and just take a look at this one. And I've already went and did this one also. I just thought it might be a little bit easier. Let's walk through the transactions for each. So they kind of give us, a starting point here. They're telling us 2.5 million shares, $2 par, average price $10 per share, 100,000 shares repurchased at 15, 200,000 shares repurchased at 17. Okay, so here's my common stock number, and this number is 2.5 million shares. Okay, that's how many were issued. We retired 100,000 shares. Okay, so that's 2.4 million. And we just take that 2.4 million, we multiply it by the $2 par value, and I get the number that I already plugged in, the $4.8 million number. Okay, so let me just format this. Okay, so that's how I got this number right here. Then additional paid-in capital, it's 19.2. And so kind of the same thing. We go the same thing here, 2.5 million shares minus 100,000. So I'm just going to copy and paste this into right there. And the average, we sold them at $10 was the average price, minus $2, which was the par value, so $8. So 19.2 is basically $8 multiplied, whoops, got to get the right symbol there, multiplied by 2.4, we get 19.2. And then the treasury stock, if you recall, we bought that at $17 per share, and there was 200,000 shares. We bought 200,000, and that was at 17. So if I take plus 200,000, I'll just do negative 17, so we get a negative answer. We get the 3.4 million. So that's how I got those numbers right there. Okay, so that was question 7. Then question 8, let's go take a look at it over here. Newton Corp, organized January 1 of 17. On that date, it issued 200,000 shares of $10 par common stock at 15, 400,000 authorized. During the period from January 1 of 17 to December 31, 19, they had net income. So for that 3-year period, income of 750 and dividends of 380. On January 5 of 19, they purchased 12,000 shares of common stock at 12 per share. On December 31 of 19, they sold 8,000 treasury shares at $8 per share. So what's the book value of total shares December 31, 19? So we're covering quite a few years here, 17, 18, and 19, with quite a few transactions. And again, I kind of just put that together for us. And this is, I really like tables like this. These really kind of help you reconcile everything. So with this one, we're just kind of looking at the various transactions given to us. And on January 1 of 17, we issued 200,000 shares, $10 par for 15. So, obviously the calculations aren't too tough here. $10 times 200,000 is my 2 million. And then the extra, the $5 between 15 and 10, that $5 difference times 200,000 is my $1 million. So the sum of the two is $3 million. My net income from 17, 18, and 19 was 750. That goes right to retained earnings. My dividends paid in 17, 18, and 19 was 380, goes right to retained earnings. And then we purchased 12,000 shares at $12 for Treasury. So that's a negative. So we need the Treasury column is always a negative, okay, when we first buy it. And then we sold 8,000 shares at $8 from the Treasury stock. So recognize that we sold them at a loss. That's the key thing to remember here. So we bought them at 12, we sold them at 4. And so this treasury right here is the 8 times 12 for 96. That's a positive because we're reducing that. And then the difference goes to a reduction in additional paid in capital of 32,000. So the sum of the two has to work out to be the total is F64. Okay, so those are just kind of the simple type of transactions that we would do. And we didn't do these in journal entry format. We just kind of said, how would they directly impact equity? And that's really what the question was trying to help us figure out. And they want us to know what the balance was of total equity when this is all done. That was kind of really the answer to the question. It's the 3,290,000 is the total equity balance after these transactions are done. Okay, then question 9. I started that one, but I didn't put in all the numbers. For question 9, December 31 of 17, the equity section of Mercedes Corp is as follows. So kind of the usual common stock, additional paid in capital, and retained earnings. Par value is 5, 30,000 shares authorized, 9,000 shares issued and outstanding. On March 1 of 18, the board declared a 10% stock dividend and accordingly issued 900 shares. So everybody can kind of catch 10% of 9,000 is 900. The stock's fair value at the time was $8 per share. For the 3 months ended March 31 of 18, they had a net loss of 16,000. So in the first quarter, they lost 16 grand. What amount should the company report as retained earnings on its quarterly financial statement dated March 31 of 2018? Okay, so let's go ahead and do this one. So this is 15.9. And the first thing to do is to think about the journal entry to record the stock dividend. Again, something you probably did in principles. If you've taken intermediate, you for sure would have done it there. Not a tough entry though. That's good. And so remember that we issued 900 shares, so 900, and we multiply that by the fair value. They said the fair value of those shares was $8 on the date of the dividend. So that's $7,200. And then the par value was $5. So 900 shares times 5. That's my par value. And then the difference between the $8 and the $5 is $3. So 8 minus 5 is 3 times 900. And that's my credit to additional paid in capital. So that's my entry right there. Okay. So debit dividend, credit common stock, credit APIC. And then what they want us to know is what is the retained earnings balance on March 31 of 18. Okay, so basically we have to know what the beginning balance was. And we go back to the problem. And the beginning balance was $73,000 right here, December 31, 17, the ending of the year. And they want us to know what's the retained earnings balance for the first quarter of 18, March 31 of 18. So beginning balance was 73. They said we lost 16,000, so that's a net loss that reduces retained earnings. And then we have the dividend. And so the dividend account, we debit dividend here. Well, that's a direct reduction to retained earnings. So that makes retained earnings go down by 7,200, and we get 49.8 as our new retained earnings balance for March. Okay, so keep that in mind. Even though this was a stock dividend and not a cash dividend, it still is a debit to dividends. The dividend account directly reduces retained earnings. So that's a very important thing to remember. Okay, question 10 is right here. And this is computing weighted average number of shares. So this is Mason Manufacturing, 600,000 shares of common stock outstanding, 150,000 shares, $100 par value preferred stock, January 1 of 17. An additional 120,000 shares of common stock were issued on August 1, and 24,000 were repurchased and retired on December 1. Mason's preferred stock is not convertible into common shares. And that's good to know. We're going to run into that one later. So now they want us to know what's the weighted average number of shares to compute the basic earnings per share. Remember that GAAP requires when we issue an income statement that we also issue the earnings per share information is what they call basic and diluted. And we'll do calculations for both. This one's easy because we just do the basic because their preferred stock cannot be converted to common, which means there is no dilution. So we just have the basic calculation and that's it. So that's easy for us. So I already went ahead and did this one for us, 1510 right here. So on January 1, we started out with 600,000 shares, and we had that amount for the full year. We had at least 600,000 for the full year. So that weight is 1 or 100%. And so the weighted average is pretty easy, just 600,000. Okay. Then on August 1, we issued 120. So just saying January through July is 5 months. So January 1 to July 31, that's 5 months. Okay. So 5 months out of 12, we had 50,000. So so just take that ratio of 120 times 5/12 and you get 50,000. Okay. Then we repurchased and then retired 24,000 shares on December 1. So that's only 1 month. And then 1 month is left. And so, and I said that backwards with this August one. August through December is 5 months. I said that backwards earlier. 7 months went by, 5 months are left. With this one here, there's 1 month left, the month of December, and that reduces this by 2,000. So you can see what I did here. 24,000 times 1/12 gets me down to 2,000. Okay, so total is 648. Okay, so that was question 10. And then let's go ahead and take a look at question 11. I gotta get to my notes here. Or, I'm sorry, I'm skipping 11. We'll go to 12. And 12 is right here. And this is determining shareholders' equity after a stock split. Okay, so we're going to do a stock split. Didn't say that right. Effective April 27, 2017, Door Corporation shareholders approved a 2-for-1 split of the company's common stock and an increase in authorized common shares of 100,000 shares, par value of 20, to 200,000 shares, par value of 10 per share. The stock split shares were issued on June 30th, 17. Door accounts for the split as a stock split as opposed to a stock dividend at the date of the declaration. The fair value of shares is 60, and Door's equity accounts immediately before issuance of the split were as follows. So this is right before the split. So common stock recognized the par value is 20, 100,000 authorized, 50,000 outstanding, additional paid in capital, and retained earnings. After the stock split were the balances of additional paid in capital and retained earnings on June 30 of 2017 equity. Okay, so that's what we have to figure out kind of. So they did the split on June 30, and so what does my equity look like right after that? That's what we're trying to figure out. Okay, so good news is this is really easy. Okay, so it's kind of a trick question because these numbers here don't change. Okay, so it's kind of more informational when we do a stock split. So none of these change. This is all the same. What's different is the par value is now going to be divided by 2. So we did a 2-for-1 split. Okay, that's easy. So I just divide 20 by 2 and I get 10. And then I double the shares authorized. I multiply that by 2. I get 200,000. And then I take the 50,000 shares outstanding. I multiply that by 2. I get 100,000. So that's it. That's the only change we make. This is $10, 200,000, and 100,000. That's all that we do. Once we do that, we're all good. Everything's the same. Okay, so that's an easy one. Then we do question 13, and this is TAM Company. Net income for the year, December 31 of 17, was 10,000 during the year. They declared a paid $1,000 cash dividend on preferred stock and 1,750 cash on common stock. On December 31 of 17, they had 12,000 shares of common stock issued and outstanding, and they had 10,000 had been issued and outstanding through the year, and 2,000 issued July 1 of 17. No other common stock transactions occurred, and 5,000 shares of preferred stock are not convertible into common shares. So what should be the 2017 earnings per common share of TAM company rounded to the nearest penny? And watch those kind of questions in your Connect homework when they talk about rounding. Just be really careful about rounding the right way. That can throw you off sometimes, and that gets frustrating, I know. Okay, so thankfully, easy computation. I put the computation in here for us right here. So this is the basic earnings per share computation formula. We just take net income, we subtract preferred dividends from that, and then we divide that by the weighted average common shares outstanding. And that's makes it fairly easy for us, thankfully. So with this one, they had 10,000 shares issued for the full year. And then they also issued 2,000 shares on July 1. So we had for sure 10,000 for the full amount of the year. So that's 10,000. And then we issued 2,000 on July 1. That's easy because we can just multiply that by 6 over 12, half the year. So the number of shares outstanding is the sum of those two for 11 grand. Okay. So we had 11,000 shares outstanding. Okay. So with that, then we then take net income and we divide that by preferred dividends. Okay, so net income and net income for us was $10,000. And I subtract from that the preferred dividends of $1,000. Okay, and that's the key. So I'm taking 9,000, and I should put this over here. I take 9,000 and I divide that by 11,000 shares. So 9,000 divided by 11,000, and I get to 82 cents. Okay, so just really watch your rounding just in case. And I want you to recognize too in this question, um, the preferred stock dividend of 1,000 mattered. What they paid for common stock dividends did not matter. I want you to recognize that. Okay, so they told us that number of 1,750, but it didn't matter. Okay, did not matter. We did not use that in the calculation. Okay, we're in the home stretch. We just have one left, question 15. And for question 15, I'm sorry, we got two left, 15 and 16. For 15, it is right here. And they're giving us earnings per share again. And they're giving us two different time periods, common stock, how many shares, convertible preferred stock, and now convertible bonds. And this is what's important now with this one, is I have preferred stock and I've got bonds that are now convertible into common shares. So this is going to make the earnings per share calculation a little bit more challenging. And then during 17, Petrock paid dividends of $1 per share in common stock, $2.40 per share dividend on preferred stock. Preferred stock is convertible to 20,000 shares of common stock. So this preferred stock can turn into 20,000 shares of common. The 8% convertible bonds can convert into 30,000 shares of common stock. So the preferreds, 20,000 shares can turn into commons. For the bonds, 30,000 shares can turn into commons. Net income for the year ended December 31 of 17 was 285. Tax rate was 40%. Okay, so those are all the issues to kind of think through. So question 1, basic EPS, and then question 2, the diluted EPS. And I've already went ahead and did this one just to kind of help us figure it out. So for sure, we had 5 million shares, right? That was no question about that. So we've got, let me go back to the problem here. There we go. So for sure, we had, oops, I did the wrong thing. My bad. Hold on one second. Okay, I fixed it. I had some bad info in there. Let's go back and look at this question here. So got the commons, the convertibles, and the bonds. Okay, so I've got those. And let's go back and take a look at what we put together to compute this. So I've got the earnings per share, I've got the basic, and I've got the diluted. So the common shares were 90,000 for both. The bonds convert to 30,000 shares of common. The preferred converts to 20,000 shares of common. So this total is 90 for basic, 140 for diluted. My net income for both is still the same, 285, but then I have to adjust each one based on the conversion. So On the bond, the after-tax interest on the bond, I want you to see the calculation. And I took 100,000 times zero point 0.8 time, oops, I'm sorry, that should be $1,000,000 times 0.08. Let me get this right. Let me get my zeros in the right spot. There we go, $48,000. So $1,000,000 times 0.08 times zero point 0.6. Let me tell you where those numbers come from. So the value of the bonds was 1,000,000. The 0.08 is the interest expense, and then the 0.6 is 1 minus tax, and tax was 40%. So 1 minus T is 0.6. Okay, so 1,000,000 times 0.08 times 0.6 is my calculation for after-tax interest on the bond. And then my preferred dividends, and that was just simply 2.4 per share, which they told us, times 10,000 shares, $24,000. So on the basic, I have to subtract that. On the diluted, I don't, because those have been converted, right? If I do the diluted, those don't exist anymore because they now became common shares. But I would still have to deduct the bond interest. So that gets your calculations right there. Okay, now we truly do have just one left. And this is question 16. And right here, on January 1 of 17, Amos Corp granted non-transferable, non-qualified stock options to certain key employees as additional compensation. The options permit the purchase of 20,000 shares of their $1 par common stock at a price of $32 per share on the grant date. The stock's market value was $32 per share. Options were exercised on July 1 of 21, expired July 1 of 2025. On February of 23, the stock was selling for 53. All options were exercised. The tax rate's 35. They had December 31 year end for financial reporting purposes. Required how much compensation expense should Amos record in 17 and 18 if the options are worth 15 per share on the grant date. Compute the tax benefit that Amos will receive in 23 when the employees exercise the options. And I'm guessing you've probably not seen calculations like this one, so this is probably pretty new territory. So the key with these is they're treated like expenses, and that's really what I would say is the thing that matters the most. And I see this should say 2023, by the way, not 2013. So 2023. So in 17, we issued these. And this $300,000 that you see right here is that the compensation cost was 15 times 20,000, okay, for 300,000 shares. So 15, that's the amount right here, the $15 times 20,000 shares. It gets you to 300,000. They vest in 4 years. And if you ever heard of that term vesting, this is very common when it comes to anything that a company will give you as compensation besides your salary would have to have a vesting period. Now, for a 401k, that's not usually the case. For most companies, your 401k, you earn it by working there. And so the company, let's just say they match 3% of what you put in, and that vests every year. So when they put your money in, for every pay period, when you take some money out, put it in your 401k, and they match that, that immediately vests. So don't confuse that with a 401k. But if you have a pension, if you've got something that deals with stock, then there's typically a vesting period. I worked for a company that you could buy stock of the company and you had a vesting period. You earned it every year, but if you left before the vesting period was completed, you didn't get it all. So you had to work there for, I believe that was a 3-year vesting period, if I remember right. It's been a long time, but I believe it was 3 years. So if you worked there for 3 years, anything that you was given to you as stock as part of your compensation, you 100% earned it once you were there for 3 complete years. And they had different rules, like a year had to have so many hours in it. So like if you started mid-year, as long as you worked so many hours, that year counted. But there's all kinds of calculations for that kind of stuff that we don't have to worry about right now. In this example, for these stock options, there's a 4-year vesting period. So the annual cost of the options is $75,000. Okay, so that's the kind of the key thing to remember. Now, in the first year, though, it was a half-year convention. So for this first year, these were exercised in the middle of the year. So the expense is just 37.5, and then 18 we would have had the full amount and so on. So basically, for all of 18 they existed for half of 17, July 1 to December 31. Okay, so then we'll flash forward to 2023 when they're all when they're all exercised. So the stock price when they were exercised was 53. The exercise price was 32. So that difference is $21. Okay, there was 20,000 options. So the deduction for the company then is 420, and then the tax rate is 35%. So the company is going to recognize a tax benefit of 147. Okay, so my hunch is that this is something fairly new to you. So hopefully this will give you a little bit of a guide to help you out with the homework problems for the week. As always, if you've got questions, feel free to let me know. I'm more than happy to point in the right direction and give you an assist if needed on the homework problems. Thanks.